You know this camera stand that I'm using right now, it looks like it's about ready to split in half any minute now. But you gotta work with what you have, so.
I've been trying to run from my problems to keep another one from adding on. I feel so numb, I'm so far gone, cause the collateral damage is done. Just need to exhale.
Hey everybody, welcome back to my channel. Thank you for stopping by again. This is part 2 of how I passed my funded challenge. So in this part, we're gonna be looking at the charts together. You guys are gonna see a little piece of how I view the markets. I'm gonna show you the trades that I took to pass the challenge. I'm also gonna explain the psychology behind why I took the trades. You guys are gonna be hopefully, I don't wanna say impressed, but you're gonna hopefully hear what I say and be like, oh, I didn't think of it like that. I'm hoping that you get that like aha moment, you know what I'm saying? So yeah, let's dive right into it. All right, so we're gonna get started with coming back inside of my my dashboard. What is this? This is the funded account. So obviously I'm off to a good start. Let's go back now to step 2. Profit factor of 5, outstanding. Projected annual profit, I'm guessing they calculate that based on your equity curve, so that's pretty cool. Then the average risk reward ratio is 3.87, so that's really good. My personal goal is to consistently have a risk reward ratio of 3 or better, 3 to 1 or better. So we're right there. The average winning trade was 240 and the average losing trade was $60. Now let's transition over to the charts. As of right now, it is Monday, July 18th. 1 second. McDonald's knows how to make ice water. All right, so let's get started. So let's back up a little bit. Right now, I just got off of taking my first trade on my funded account. I'm just showing you guys that real quickly. I wanted to position myself here, but I have the standard account for the funded trader, so I can't hold trades over the weekend. This last shake happened on Friday, so I wouldn't have been able to position myself there anyway, but I was able to still position myself here, right here, and I will walk through this trade right here in a different video. So if you guys remember from the equity curve of my phase 2, I started off in a little bit of a drawdown. I applied really good risk management here. I took 26 individual trades to make up my singular position. I have to show you guys how I view the markets from top down. Let's hide all the drawings so we have the clear price action. This is the pound JPY Forex pair. This is the only thing that I trade. The way that I look at the markets, I try to look at the market in terms of where other traders are likely going to be positioning their trades. What do I mean by that? Well, let's first start with the daily time frame. When it comes to the daily time frame, I look at where price has been, where price is at now. And obviously, just like everybody else, I try to anticipate where price might be in the future. But I also really try to focus hard on what's going on in the present. What we see here from the weekly time frame, we are pretty much at this original rally point that was established way back in 2009. So we're still at this point and we're kind of maintaining around that. In fact, the actual peak of this point is now an average that price is kind of dancing around. Average price is a big part of how I gauge sentiment and position myself in the markets at certain prices that suit me. Let's go down to the daily time frame. Let's once again take away all of this drawing stuff. So we look at the daily time frame. We just got out of a trading range, then impulse out of it, and now we're inside of another trading range. I trade support and resistance, but beyond that, outside of the boundaries of your typical supply and demand zones or support and resistance zones are areas where stop losses are going to be at, stop orders, limit orders, they're all going to be there, and that's where liquidity is. Liquidity in layman's terms is money that is sitting there at a certain price that's waiting to be poured into the market via stop losses, limit orders, stop orders. So on the daily time frame, we got the impulse that came to 168 and then we fell back. So we call this a climactic event in the Wyckoff world. Price rallied to this point, came back to the average of where where the buying got exhausted and where the bullish sentiment or bullish fervor reasserted itself. and came back to the average, which is the dead center of those 2 points. Remember that word, average price. That's gonna be a big part of my strategy moving forward. And we're gonna get to the trades that I took to pass the challenge, but I think it's important for any of you guys that have some sort of familiarity with trading to understand where I'm coming from in terms of the big picture. It's all about the big picture. It's all about understanding what happened before, what's likely to happen in the future, and on the way to that future, what's gonna happen to try to grab up as much liquidity as possible to make that push happen or make this decline happen. Or if panic ensues because the Fed press conference is coming in 2 weeks, depending on how the price is shaping up, because the insiders, they already know somewhat was coming, right? So you're gonna see their hand exposed in ways via the price action. You just gotta be able to know how to read it and kind of position yourself in certain spots. And it takes a lot of time and experience to figure out. So we identified this as our climax and our rally point. And then price tested beneath a little bit more. I'm guessing there was some liquidity coming from here, a lot of volume. Quick side note, the indicators that I use a 50 EMA moving average, a 100 EMA moving average, and a 240 EMA moving average to gauge trends. All right, I like to operate in trends. In trends, what typically tends to happen is price will accumulate, grab up positions, initiate, reaccumulate, grab up positions again, gone, trend, trend, trend. Along the way, you have minor reaccumulations going on. I like to operate within those areas, within these ranges of accumulation. And then when we get to the end of an uptrend, we start to distribute. Guys start taking profits, big boys start getting out, and obviously a new campaign is developed to start a downtrend where we redistribute. In addition to the moving averages, I use volume flow indicator, and that really just tells me a couple important pieces of information that helps me gauge where liquidity might be sitting in the market. That red line that you see going through the volume flow indicator is called the point of control. That is the price point that has the most volume traded. So typically that's going to be the same thing as the average price. Now let's go back into the actual trade that I took. So long story short, we came across a major location of resistance right here because price developed a staircase. I call it a staircase formation here. We have a channel that then ruptures rapidly and mercilessly. Once it does that, typically the final location of demand before we get to that final impulse that breaks, it typically serves as a very strong source of resistance if price were to meet it again. And lo and behold, that's exactly what happened. But prior to this happening, we had just come from what seemed to be a strong sell-off that then got rescinded very aggressively. The thrusts got shorter and eventually we thrusted back up. And the thing that told me that this meant that buyers jumped in was, again, the volume flow indicator. Before all of this happened, when we were only here, you see that at the time, the point of control shifted. It used to be up here where we just came out of price distributing and then selling off. But when we got here, now you see a whole bunch of volume coming in at this price. We danced around this price, sold off a little bit, collecting liquidity, because when this low is created, now you got traders getting in at this price. Their stops are going to be underneath. The market went and got it. So now traders are getting in here. Now their stops are going to be underneath here. We created the impulse, which bolstered the bullish sentiment of those who entered here. But then sure enough, the market went and got that liquidity too. That liquidity being their stop losses. So the week before, I took a lot of losses here because I was still trying to sell. Notice where price went. Notice how we're trending here. We're creating all these lower lows, right? So buyers and new buyers are getting in here, 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 and look where the market came. Anybody who wasn't already well positioned here, south of this point, anybody who got in north of this point and had their stops tight was eliminated right here. And that gave the market enough liquidity to now push higher. So now we go to the week where I passed the challenge. Step 2. I actually opened up this week trying to buy. Once we broke out of here, I assumed that this level would now hold as new supply, or no, sorry, new demand or support. You know, I'm just gonna use the word support and resistance to keep it simple, because those are the words, those are the terms that most people know in the trading space. So I assumed that once we broke out of this so convincingly to start off the week, that we would maintain this level as a level of support. So I bought here, trade was looking good. We seem to have been building momentum. Buying was induced. I added some size, and then I saw that we kept failing when we got to the value area low of this initial distribution that started this selling. Okay, I'm going to talk about value area highs and value area lows in future videos. Basically, I ended up buying here, took a loss, bought here, took a loss, bought here. I didn't take a loss for this one. I broke even here because I saw what was coming and I got out before it was a loss. And when we finally got to this point, we need to get rid of this yellow line. When we finally got to this point, which when we back out to the 1 hour time frame, is the same level where we previously went and got the liquidity. It's also a level where volume came in droves before. So this was a very strong level of support. Not only that, check this out. In the grand scheme of things, price sold off, corrected, and then reaccumulated. You want to know how we knew that after we saw this? Climax, rally point. Sometimes the market retests the same rally point. Sometimes the market tests below the rally point. In this particular situation, because so much volume came out of here, price got here, volume just died. So it rejects and then buyers jump in, pushes price higher, and that erased any selling sentiment beneath this point. That's why we didn't need to go down here to get any more liquidity. I'm only assuming that was why we stopped here and then rejected higher instead of coming beneath this point like the markets tend to do so often. I deduce that whenever we've come to a place where there's so much volume, so much sentiment in a certain direction of the market, there is no need to go grab liquidity down there because you've already removed the competition. There's no selling interest at that point. So there's nothing stopping us from continuing this uptrend. Some of you will not understand what I meant by what I just said. Don't worry, I'll clarify that in future videos. But long story short, this is where I took the buy to get the trade. And like I mentioned before, I could have held it all the way through the duration where we broke this high to finish the week at this very same level of resistance. But I only needed this to pass the challenge. Once I got that, I closed the positions out and I passed it. So that is how I passed the challenge. You guys just got a quick little sneak peek into how I view the markets. It's a lot, it's simple, but at the same time, trying to explain it, it's complicated. So I didn't want to go too in depth in it. I'll make another video talking about it in depth. I noticed that the thrusts were getting shorter. Shortening of the thrust is what we call it in the, for those who study the Wyckoff method. Others will call this a falling wedge. But really, it's no different than the way that I see all structures. Have our climax. And I know that it's the climax because it is, to this point, it's been the strongest challenge to the selling momentum. Let's put, in an instant. Let's just put it that way. This was a climax. And then as the structure unfolded, we saw that, in the end, we ended up just continuing to sell off. Whenever I mark my climax and my rally point, I still don't know yet whether price is accumulating to take us higher or distributing to take us lower. I still have to wait and let the market tell me what is going on, who are we going after, and when we're done going after them, what's next. I think like a predator. I think about where's the liquidity at and are we gonna go get it? I positioned my first trade here. I call it my initial position. Once I saw that hit, same level, same point. Sometimes GJ does that. Stops at the same point and rejects. Once I zoomed out to the 1 minute time frame and saw that price in its own local way was accumulating down low, this candle that engulfed the previous three told me everything that I needed to know, that possibly there's some strength here and it's gonna take an absolute collapse to go beneath this. So once price retested this again, I added more size. Every time we would thrust and fail to break beneath this low, and consistently, I would add more size. Thrust, test again, fail, add more size. Thrust out, come back to the average of the initial thrust, reject, add more size. That's how I do. Tells me that the bias that I had is potentially correct. That's how I found that trade here, rode it to here. But if I had held this trade, it would have been an absolutely massive profit because I would have gotten out here. I would have gotten out here, or at the very least up top. So take care, you guys, and I'll see you in the next one. Peace.